Hello everyone, and welcome back to our channel. In today's video, we're going to talk about new crypto news that will destroy the crypto market. A cryptocurrency, or crypto, is a digital asset designed to work as a medium of exchange wherein individual coin ownership records are stored in a ledger existing in a form of a computerized database using strong cryptography to secure transaction records, to control the creation of additional coins, and to verify the transfer of coin ownership. It typically does not exist in physical form, like paper money, and is typically not issued by a central authority. Cryptocurrencies typically use decentralized control as opposed to centralized digital currency and central banking systems. So, if you want to know more about news that can destroy the crypto market, then get yourself comfortable and keep watching, because you are at the right place. But before we begin, don't forget to like and subscribe to our channel, and turn that notification bell on so you don't miss any of the videos we post. Let's get started. First, let's talk about some of the most used cryptocurrency types. Bitcoin. Bitcoin is a cryptocurrency invented in 2008 by an unknown person or group of people using the name Satoshi Nakamoto. The currency began to be used in 2009 when its implementation was released as open source software. Bitcoin is a decentralized digital currency without a central bank or single administrator that can be sent from user to user on the peer-to-peer Bitcoin network without the need for intermediaries. Transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. Bitcoins are created as a reward for a process known as mining. They can be exchanged for other currencies, products, and services, but the real-world value of the coins is extremely volatile. XRP. Ripple is a real-time gross settlement system, currency exchange, and remittance network created by Ripple Labs Incorporated, a US-based technology company. Released in 2012, Ripple is built upon a distributed open-source protocol and supports tokens representing fiat currency, cryptocurrency, commodities, and other units of value such as frequent flyer miles or mobile minutes. Ripple purports to enable secure, instantly, and nearly free global financial transactions of any size with no chargebacks. The ledger employs the native cryptocurrency known as XRP. Ethereum. Ethereum is a decentralized open-source blockchain with smart contract functionality. Ether, ETH, is the native cryptocurrency of the platform. It is the second largest cryptocurrency by market capitalization after Bitcoin. Ethereum is the most actively used blockchain. The Ethereum Virtual Machine, or EVM, can execute scripts and run decentralized applications. Ethereum is used for decentralized finance, the creation and exchange of NFTs, and has been utilized for many initial coin offerings. Dogecoin. Dogecoin is a cryptocurrency invented by software engineers Billy Marcus and Jackson Palmer, who decided to create a payment system that is free from traditional banking fees. Dogecoin features the face of the Shiba Inu dog from the DOGE meme as its logo and namesake. It was introduced on December 6, 2013, and quickly developed its online community, reaching a market capitalization of US $70,355,561,773 on April 16, 2021. Cardano. Cardano is a public blockchain platform that aims to run smart contracts. It is open-sourced and decentralized, with consensus achieved using proof of stake. It can facilitate peer-to-peer transactions with its internal cryptocurrency ADA. The project differentiates itself from competitors by using a research-driven approach. The platform is designed through peer-reviewed papers written by computer scientists and academics. So now that we're aware of different types of cryptocurrencies, let's talk about breaking news, which may be the end of the cryptocurrency. Here are some possible reasons which could cause crypto to crash. Reason number 1. Governments banning cryptocurrencies. Bitcoin believers continue to tout the digital currency as a viable hedge for inflation risk and the potential debasement of fiat currencies. As it is not only India, governments across the world have started banning them, so it was a bit surprising that India tolerated the bohemian idea of cryptocurrencies for so long. But now the government plans to introduce a new piece piece of legislation that will outlaw Bitcoin and other cryptocurrencies. India also plans to introduce its digital currency, thus making crypto worthless. It would not be a cryptocurrency if a government issues it. The crypto experts expected this, but they underestimated the power of the state. Since 2009, when Bitcoin was created, some of the brightest tech bohemians have sold the world a lemon, that a new kind of global currency will end the monopoly of governments and central banks over money. This new currency will not exist in physical form. It will be created from nothing by a vast network of computers as they perform a vast number of computations to randomly create it. The currency will have no intrinsic value beyond the perception that it has value and its predetermined scarcity. The lure of a cryptocurrency is that it can make transactions between two individuals secure and possible without inefficient intermediaries like banks and rulemakers like governments. It offers complete anonymity and freedom, two things that governments, including democratic ones, dislike. Governments dislike even their currency notes, as it provides anonymity and too much freedom. History is filled with wild things that were supposed to be free, but eventually got regulated by governments. The internet itself was supposed to diminish government control, as no single power can destroy it. Yet, every government has the power today to regulate it. Social media, too, was expected to transform the world, especially through photogenic rebels on Twitter and Facebook. But these platforms are now begging governments to let them be. Streaming channels were supposed to force conservative societies to accept the freedom of artistic expression, but as evident in India, they have meekly agreed to censor themselves to massage the thin skin of a majority. Cryptocurrencies, too, will fail. You may argue that they'll survive in a less rebellious form, but then crypto has a binary quality. Either it is entirely free of state control, or it's just another fiat currency in digital form. Reason number 2, the volatile nature of cryptocurrency. Investing in cryptocurrencies is very risky. Like the majority of startup companies, most crypto assets will fail, and therefore become worthless, Anderson says. Non-professional investors should only invest in amounts they're willing to lose. Despite stories of investors making millions, investing at an inopportune time can result in rapid and extreme losses. As late as May 2017, 1 unit of Bitcoin was traded for roughly $1,500. At its peak in December of 2017, Bitcoin got as high as $19,800. Recently, Bitcoin has ranged in price from $6,600 on April 15th to $10,000 on May 7th. Although the chance of becoming rich by investing in cryptos is exciting, this market is extremely volatile, and there's a real possibility of great losses. Cryptocurrency is known for funding illegal transactions, yet legal businesses also accept cryptos for transactions. Cryptos offer speedy, low-cost money transfers. This makes using them for international money transfers popular. A $99 million Bitcoin LTC transaction took only 2.5 minutes and cost the sender less than $1 in transaction fees. Cryptos are free from authorities and can't be frozen. That's because only an owner with a private key to the wallet has access to the asset. Investors can also speculate in listed cryptocurrencies, betting on which ones will succeed and which ones will fail. As for any market, the future of cryptocurrency is not guaranteed. I believe that cryptocurrencies will implode and no longer exist in any meaningful sense in a few years, and that the entire cryptocurrency market is a bubble, says Robert R. Johnson, professor of finance at Creighton University. Johnson thinks the cryptocurrency market is driven by the greater fool theory, as investors rely on new buyers to bid up the price. If Johnson is wrong and the cryptocurrency market doesn't fail, there remains the question of which digital currencies will survive. With thousands of entrants in the market and new offerings emerging, not all will last. Investors who want to dabble in this market should probably stick with the most well-known names such as Bitcoin, Ethereum, and Litecoin. It's also wise to learn a bit about the market for each before investing. Blockchain is popular with a variety of financial institutions and other users. Since cryptocurrencies are virtual and lack a central storehouse, an account balance can be wiped out. For example, a computer crash without a backup could destroy a stash of cryptocurrency. If a user loses the private key to their wallet, the cryptocurrency they own is unrecoverable. Scammers can also hijack someone's someone's mobile account by impersonating an account holder. Thieves contact the carrier and request the user's SIM card to be transferred to a new device. This gives scammers access to cryptocurrency accounts. It's therefore necessary for investors to keep track of their private keys and use a wallet from a well-established firm. Professionals also suggest backing up your cryptocurrency private keys and using strong passwords. Reason number 3. The IRS does not consider crypto to be currency. In the US, the Internal Revenue Service considers cryptocurrency as property. The tax rules that govern property investing also apply to cryptocurrency investing. This ruling imposes extensive record-keeping requirements, and the IRS is making tax enforcement of cryptocurrencies a high priority, with steep penalties, says Robert Elwood, partner at Practice, a Philadelphia law firm. So transactions in taxable accounts should be undertaken only when the record-keeping burden is worthwhile. If enacted, the Virtual Currency Tax Fairness Act of 2020 could encourage more cryptocurrency use because taxes would only be levied on the digital currency if the gain of a transaction is greater than $200. This would enable individuals to easily pay for smaller purchases with digital currency. That said, cryptos held in retirement accounts are protected from tax, as are other assets owned within these accounts. If you received any virtual currency as payment for work performed, you are expected to report that as well. The difference is, in that scenario, the crypto is treated like wages, which are subject to ordinary income taxes, as well as self-employment taxes for those who are paid as a non-employee and receive a 1099 NEC from the business that paid the crypto, Hauer said. Again, even if you don't receive a form, that does not relieve you of your responsibility to report the income and pay any taxes owed. Well, that's it for today's video. I hope you liked it. Please don't forget to share your thoughts in the comments section down below. Thanks so much for watching. See you next time.